Welcome back to the Gray Report. Once again, joined by Griffin Haddad, Investor Communications Manager here at Gray Capital. Griffin, look at all this. There's a lot that we have to talk about. I mean, the economy is uncertain. The multifamily industry is uncertain. Some deals are trading for sub 5 caps. Other deals are trading for, 6+ caps. If you talk to different buyers, they want to trade, what they want to buy new stuff. They want to buy it for cheap. Mm-hmm. Sellers, they're saying, pound sand. It's hard to make sense of it.
Raises the question, does anybody really know what's going on?
I don't think one person does. I think as soon as you think you might know, you need to look at yourself in the mirror and really question this statement. I think the smartest people in the world don't really have a good sense of where we are and where we're going.
Which is why the Gray Report and all of these articles, research, opinions, put them all together, read what you choose to read, formulate your own opinion. But the best thing you can do for yourself in a time like this is just equip yourself with data, knowledge, opinions from folks that are claiming to know. That way you can be well equipped to move forward.
Yeah, got to synthesize it. And it's amazing how quickly the narrative changes. I think it's about every 3 weeks. Mm-hmm. And it's been like this for the last couple of years. But every 3 weeks, we oscillate between going into a recession versus we're right in the sweet spot. This economy is going to keep just chugging along. And even though the entire economy has wondered whether we were going into a recession with employment in a potential scary picture, is AI taking jobs or seeing some job losses, but the unemployment rate is still slow. Inflation is higher than we want it to be, but it's not necessarily horrible. But then, then there's the, public companies like NVIDIA that are coming back and saying we've got some really strong earnings. Mm-hmm. And maybe that there is some real just solid growth that is going on. And maybe not everyone is being fired because of AI. Maybe it's efficiencies. Maybe it's just companies that are, being cautious and conservative after a period of overhiring. Mm-hmm. We don't know, but just as you said, it's aggregating all that information, putting it together, synthesizing it, and being up to date to allow us to make some good decisions. Because we all know that there are incredible opportunities whether it's a period of distress, it's a period of uncertainty. Because while a lot of investors, a lot of allocators will stay on the sidelines, that's when the best deals are had. Now, obviously, you don't want to catch a falling knife. You don't want to put yourself in a bad position. You want to be risk averse, but you don't want to allow being risk averse to prevent you from seizing really good opportunities. One thing that we do here at Gray Capital to help ourselves, but also our investor partners, is we produce these research reports, aggregate information. We do our own data analysis. Hugh and our data analyst, John Chapman, did an incredible job on our latest research report. It's the Gray Capital Midwest Multifamily forecast for 2026, where we're highlighting what is it? 6 markets throughout the Midwest, some of the top markets. I'm also analyzing some national figures to really just understand what next year is going to look like. Mm-hmm. And we weren't the absolute first, but one of the first outlets that started reporting that 2026, most likely we're going to see a below trend rent growth. Now in the Midwest, different from the nation, it looks like we're going to see some positive rent growth, but still subdued from what people like to see. I mean, usually, again, you like to see rent growth in kind of the 3.5 range organically, because part of this whole business is, your revenue needs to be growing faster than your expenses. Like if you had to strip all, it's not just real estate, obviously, any business, but like what we're in the business of doing is we have a revenue stream that's going to go faster than our expenses are going to grow. And so as that spread between our revenue and our expenses widens over time, mm-hmm. We've got more net operating income, we've got more cash flow, and that net operating income, as it grows, you put a cap rate underneath it, and that translates to a much higher valuation. But if expenses are growing faster than revenue, well, you're screwed. You're moving in the opposite direction.
Right.
And so when inflation is potentially 3%, PPI came out this morning. Mm-hmm. It's about 2.7 year over year, which isn't too crazy. It's higher than what the Fed wants to see. But if your rent growth is only growing, for Columbus, we're looking at Columbus as an example. If rent growth is only growing at 2.2%, you got a negative spread there.
You do.
It's hard to make sense of it. Now, we're buying these apartments not for year one rent growth. we're buying great capital. We buy for mid to long term holds, 5 to 10 years, typically 7 to 10. And our belief is there's going to be some strong rent growth over the next 5 to 10 years, but it doesn't have to be in year one. But it's hard to underwrite a deal with low rent growth and high expenses, which is causing a lot of folks to go to the sidelines.
Right.
You want to take us through Columbus? Just maybe a quick overview, Griffin, of some of the highlights, some of the metrics that we're forecasting in the Columbus market for 2026.
Yeah, absolutely. Columbus probably is past the emerging market category. It feels like it's kind of surfaced maybe in the last 2 years for some more national attention, but it does have quite a bit of momentum continuing into 2026, really relative to the economic growth of the city and its suburban areas. For the longest time, maybe the last 2 to 5 years, Columbus has really been a story of supply relative to multifamily developments and units. But I think the leader of this story is really demand. As this economic growth of Columbus persists and continues, it's almost like they cannot build enough apartments in Columbus because there is still a large amount of absorption. The vacancy in Columbus in 2026 will be below, I believe, or if not right at the national trend, just a decline of 18 basis points from 2025. So you can see the demand is staying relatively steady as supply begins to kind of taper off in the back half of this year and into 2026. So relative to the national average, Columbus is still a leading force in multifamily fundamentals, and within the Midwest, it's one of the strongest rent growth markets that we're projecting moving into 26.
Yeah, our national average, just going back to the national average forecast, is 0.85%, and so that 2.2% that we're forecasting for Columbus is well above that national trend. And then if you look at markets, we didn't forecast, we don't have forecasts for Sunbelt markets, but if you look at the CoStar forecast, most of them are forecasting negative rent growth. The one thing interesting about Columbus that I thought is that we're actually forecasting an increase in starts, just based upon what our model is telling us, because there's so much demand. It looks like developers, again, from our forecast, are going to actually be starting to build. Not necessarily going to be delivering, which is why it looks like they can achieve that 2.2% rent growth, but at least getting some new projects started to try to meet some of that demand. But it looks like it's going to be just much more balanced relative to where it was a couple of years ago.
Right.
All really interesting. If you want to learn more about other markets in the Midwest, if you haven't invested in the Midwest, or maybe you're a veteran, you just want to learn more, we are hosting a webinar for our forecast where we're going to go deep into each market and not only that, but kind of laying out our playbook, a Great Capital's playbook for 2026. So the webinar's on December 16th. It's at 2 p.m. It's going to be a great webinar. You'll be able to come, ask your questions. And we'll be doing it on YouTube Live. We're going to be doing it somewhere else, right? Where else are we going to be doing it?
Right. I believe we're on Microsoft Teams.
Microsoft Teams is like an easier way? Yeah. So
Microsoft Teams live stream with John Chapman, data scientist at Gray Capital. We'll dive into the methodology. And then I think the most exciting aspect of the webinar is the opportunity to really get a better and deeper understanding of how this report and our market forecast are truly guiding the forward progress of our acquisitions and asset management strategies moving forward into 2026. So if you're thinking about investing in the multifamily asset class, if you are an investor in the multifamily asset class and you're looking at the Midwest or are already allocated to the Midwest, join us and join John Chapman to decide or to discover how our forecasts are really guiding Gray Capital's operations.
Yeah, and it's not all rosies and pixie dust. We're not really pulling any punches. I mean, we could have put a report, only trying to find the positive, but markets that we're investing in saying, hey guys, rent growth isn't going to necessarily be that strong next year, but this is how we're tackling it. This is what we're doing it operationally, but also from an acquisitions perspective, why we actually think that low rent growth may provide some exciting acquisition opportunities. Why that is, you're going to have to hop on the webinar. So, go to graycapitalllc.com. You'll see a button. You can click right there. Be able to download the report, sign up for the webinar, and we'll see you there.